All right, today I want to talk about how to get the best possible interest rate when you buy a home, and we'll cover loan products, down payment as a percentage of the loan of the home price, and credit score. And as far as loan products go, we're just going to talk about FHA versus conventional because those are the two most commonly used products when buying a home. And so for the FHA loan, it only requires a 3.5% down payment, a 580 minimum credit score. Um, if you have between a 500 and 579 score, you can still buy a home. However, you will need a 10% down payment instead of 3.5%. Um, FHA loans, they typically have lower interest rates but higher mortgage insurance. And they also have what's called upfront mortgage insurance, and that is 1.75% of the loan amount. And you can either pay for this at closing, all out, or you can roll the full amount into the loan. There's no in between. And you cannot cancel mortgage insurance unless you put down more than 10%. But even still, you have to pay that mortgage insurance for 11 years. For the conventional loan, you need a 5% down payment, a 620 minimum credit score, and they typically have higher interest rates but can have lower mortgage insurance. There's no upfront mortgage insurance premium, and after you get 22% equity in the home, mortgage insurance is automatically canceled. A common strategy that people will use is they buy a home using an FHA loan and then pay it down for a few years and let the house value increase so they can build equity in the home. And then they will refinance to a conventional loan, and this helps them to avoid paying mortgage insurance longer than necessary. So let's talk about your down payment size. So the more money you're able to put down, the less risky you are to the lender. And by putting down 10% instead of 5, you will reduce both interest rate and mortgage insurance. And then by putting 20% down or more, you will completely eliminate mortgage insurance and reduce the interest rate even more. And to demonstrate this, I created a couple examples here. The only thing that's going to change in these scenarios is the down payment size. And I chose a credit score of 660 on purpose because this is where the benefits of an FHA loan are maxed out. You're not going to see a decrease in interest rate as we go through this, through these progressions. The only thing you're going to see change for the FHA loan is the mortgage insurance per month. And that's because that is a percentage of the loan amount. And as you put down more money, your loan amount gets smaller. So for the first example, 3.5% down for the FHA versus 5% for the conventional. Those are both the minimums for those programs, both at a 660 credit score. And you can see the interest rate for the FHA is 5.625, while the conventional is 7.375%. So a pretty big gap there. And then the mortgage insurance is about half for the FHA compared to the conventional, leading to a total payment of there's a difference there about $400. Let's move down to the second example where we're putting down 15% for both of the loan products. As you can see, the FHA loan is exactly the same payment except for it's a smaller loan size, so your payment and your mortgage insurance are a little bit smaller, but your interest rate is exactly the same. But for the conventional, it drops the interest rate drops by a quarter of a point, but your mortgage insurance goes from $258 a month to $51 per month, so a massive drop there. And so your total payments for this scenario is, it's a difference between $66 per month. So you went from a $400 difference in the first example to a $66 difference in the second example. I'm sorry, $166 difference in the second example. For the third one, we're putting down 20%. And again, FHA loan, only thing that changes is the mortgage insurance. And again, it's because it's a factor of the loan size. But the conventional loan drops down by another eighth of a point, interest rate, and then the mortgage insurance is completely gone, leading to a $91 difference per month. So next, let's talk about credit score. To me, this is the most important factor because it's also the easiest to control. And I don't know about you, but I think it's easier to boost my credit score than it is to save up an extra $45,000 to put down at closing. But it's going to show a lender that you're reliable. And if your score is on the lower side, you can do a couple quick things to improve it. Pay down your credit cards, get them below the 30% of their total credit line, continue to make timely payments, and then if there's any errors, dispute them and get them removed from your report. And small changes can have big effects because about every 20 points that your credit score increases, you get a slight, advantage on the conventional side. So just keep that in mind. Now, here's an example of how credit score affects the interest rate in the mortgage insurance. Again, the first row is the exact same scenario from the previous slide. But on the second example, you can see we went from a 660 credit score to a 720, and we went from a 7.375 to a 6.5% interest rate just by increasing your credit score by 60 points. And your mortgage insurance goes from $258 a month to $59 per month. So dramatic decrease in mortgage insurance and interest rate just by getting your credit score from a 660 to a 720. And then on the final row, we're going from a 720 to a 780. So our our interest rate goes from a 6.5% on the conventional side to a 6.125%, and the mortgage insurance goes down by another $20 or so. But again, to me, increasing my score to a 780 seems much easier than saving up an extra $45,000, whatever your home price is going to be. To me, that's just much easier. And then this is kind of an example showing how, as both of these increase the difference, and you can see that, as you pay more down and your credit score gets better, the conventional loan just looks better and better as you do this. In the final example, it's, decently cheaper, $80 cheaper a month to have, $60 cheaper to have the conventional loan than is the FHA loan, even though it's a lower interest rate. And so just to tie things up, when you're looking for the best rate, make sure you're choosing the right loan product for you. It's going to be a factor of your credit score and your down payment amount that you're able to put down. But remember, lower rate does not always mean lower payments, as we saw in that final example. Making larger down payments can help improving credit score. And if you have any questions, feel free to reach out to me. My email is brandon@lonestarlending.com. And if you want to, you can visit our website. It's lonestarlending.com. There's a bunch of tools and resources you can use if you're looking to buy a home. And yeah, I appreciate you watching the video. Thank you.